Okay. So, like a Professor Zhao introduced, I do a lot of big data and AI research, and then yeah. So the topic is a little different from the first presentation. Right now, I want to focus a little bit more about the big data and how we are going to understand the big data in the capital markets. So before I start talking about all the big data and stuff, some of you guys may wondering what do you mean by big data? How big is big data? This is some questions I already received from audience. So when we talk about big data, particularly in the capital market, we're talking about unstructured data, or we call it alternative data. So these are some examples of big data. So for example, press release. Firms already, they always give the press release in the capital market to inform investors what's going on with the firms. And conference call, and a lot of researches have been done about conference call. Managers, they will hold conference call, and all the hedge funds, brokerages will attend, and managers can deliver timely information to investors during the conference call. And the social media, a lot of firms actually they maintain their social media trying to disclose news on Twitter. And so all this information, like satellite images, you guys know that sometimes we can get the satellite image of the parking lots of the grocery store or hospital. So by using a satellite image of the parking lots, we can actually predict the grocery store or hospital's future performance. So these are all the examples of big data. So when we say big data, we actually mean there's actually unstructured, high-dimensional data we need to understand in the context of the capital markets. So the setting, what we are talking about here is a little different from what we discussed before. So the earlier when I talking about conference call, press release, these are all one firms trying to release some information, trying to disclose some information to the capital markets. But what we're trying to talk about here is a little different setting. We're trying to understand when hedge funds, they're trying to acquire information, how would this kind of information acquisition will help investors to understand the firm. So let me give you guys an example. Let's say I'm a Morgan Stanley. I'm a hedge fund manager at Morgan Stanley. I want to understand Microsoft. So what do we do is the manager will talk to the Microsoft major customers and talk to the cloud computing experts. We're talking to some professors in the computer science department, asking them, is the Microsoft technology is really cutting edge, or anything wrong with the technology? How long is the technology going to sustainable in the future? So what we did is we get all the transcript of this kind of conversation, and we analyze this transcript and to make us better understand what's going on with Microsoft, and then also to understand how to market digest this kind of information. So you can see that the setting we're talking about here is quite different from what I just discussed before, or all this other big data, because the press release, that's the firm trying to release information. Conference call, that's the managers trying to host the meeting to help to inform investors. But the setting we're talking about here is the investors, particularly hedge funds. They're trying to talk to different experts about the firm. They're talking about experts of sometimes competitors of Microsoft, sometimes customer of Microsoft, sometimes suppliers of Microsoft, sometimes computer experts of who knows information about Microsoft. So this setting is a little different. The information is not from the Microsoft themselves. The information is from hedge funds who actually want to know more about Microsoft. And by understanding this transcript, understanding the conversation, what really happened, it can help us to understand the capital markets. So here is the angle of the data and AI. So in a study in the future, I will introduce how we analyze this kind of a conversation using textual analysis, and also what kind of finding we can conclude from the transcript, from conversation. So essentially, there are three questions we're trying to ask in this study. The first one is, what do they talk about? The JP Morgan hedge fund, Goldman Sachs hedge funds, when they talk about when they talk with some expert and they trying to know more about Microsoft. So what do they actually talk about? So this is something we want to analyze the big data to get the contents of that conversation. And the second is, what hedge fund is going to do once after the conversation, after the conversation, they are going to sit there, or are they going to trade on the content, or is this a really informative conversation, or it's something, what kind of things they learn from the conversation? Do they trade on these contents they talk about? So this is the second information, second question we trying to examine. So the third question is, if everyone is trading on this information, what's the impact on the price efficiency at firm level? So you can see the difference between the second and third question is, the second question is at the investor level, right? So investor may trade this information, may not trade this information. But for each firm, there are many, many investors. So at aggregate level, what's the price efficiency implication for the firm? So basically, so the third question is basically at the aggregate level, what would happen for the price efficiency if investor trade at different ways. So these are the three questions we're trying to answer in this study. So what do they talk about? So this is the first question we want to understand. We have some like a contrasting group. The contrasting group is conference call. So let's look at the graph of the expert calls. Are you guys see everything well and hear everything well? Just make sure I'm not the only one talking here. You guys, everything's good?
Yes.
Okay, excellent. So look at it. So the first one is when we talk about big data and some emerging technology. First thing is how we can process this big data, and so we start from the contents. So you can see that for the expert calls, you can see the contents. Most of the time is about technology. We get keywords like cloud computing, sometimes quantum computing, and also they talk about the products, and sometimes they talk about competition, consumers, marketing. So this is the contents from their conversation, from their transcript, versus conference call. So conference call is different setting, right? Conference call is managers. They want to convey the manager's performance to shareholders, to investors, to analysts. So you can see that during the conference call, what they talk about mostly is about financial performance. So you can see that the conversation between the two settings are completely different. During the conference call, one manager wants to deliver information to the audience. The major topic is financial performance, sometimes, marketing. But over the expert call, when hedge funds, they want to acquire information from this type of experts of the focal firm, what they talk about is technology, products, consumers. So these are more important. This is like a non-financial perspective. So this is from the contents. You can see that this is really unique information acquisition. So the information we can get here from the expert call is complementary to conference call, because if the hedge funds they want to know about the financial performance, they can just attend the conference call. They don't need to spend time and spend their money to talk to experts of the focal firm. So you can see that the two settings, they are complementary. The expert calls deliver different contents comparing to the conference call. So this is basically answer the first question. What do they talk about? So a lot is about production and technology. And then, so the sample we have is about, we start with like 19,000 expert calls. And then, there's some data error, in the data because we have to identify the expert call, like what's the call about? Like, is the call about Microsoft? Is the call about Apple? There's some measurement about this kind of the firm identification. So what we did is we used the expert call transcript, and we calculate the similarity between the expert call with firms 10K item 1, and when the similarity is too low, we know that's not about firm. When it is high, it's about firm. So the 10K item 1 is basically, so let's say Microsoft. Still stick with the example of Microsoft. So item 1, 10K item 1. If you look at Microsoft 10K item 1, the item 1 will describe what exactly Microsoft do, what industry Microsoft is at, what kind of product Microsoft is using, what technology Microsoft is doing. So item 1 is basically business description of the firm. So the reason we want to get the similarity between the transcript and item 1, because we want to accurately identify whether the core is about this particular firm. If their similarity is very low, that means that the core is not about the firm. When the similarity is very high, that means the core is basically about the firm, and we can double check and then manually check if it is really about Microsoft or not. So this is how we identify the focal firm from the transcript. So there's some like a very brief overview of the finding we found. So first, we also look at what kind of firms get inquired by hedge funds. So basically, why Microsoft get picked up? Why not Apple? Why not Google? So this is like, what kind of firms will get attention from this kind of expert calls? So that's the determinants of expert calls. That's what we are trying to answer as the first part of the paper. And then I just want to briefly go over what we actually find from the study. So at institutional trading level, so basically at the investor level, what we found is hedge funds, these kind of institutional investors, they do trade on this type of conversation. So basically, they are not just talk. After they talk, they do actually trade on this conversation. And interestingly, we found they are not just, most of trading focus on sell. So what does that mean is, after the conversation, they identify some issues, which is red flag. They're trying to sell the stocks of the focal firms. So it's more on the selling side. And then we also found like, there's a lot more correlated with informed trading. So what that means, what does that mean is the conversation they learned, so the contents they learned from the conversation is correlated with their private information. So basically, what we want to, what the evidence showing is, if I'm a hedge funds, so basically after the conversation from experts with the experts, I kind of confirmed the private information I have before the conversation. So basically that's why informed trading increases. So basically the expert calls help to confirm private information hedge funds have. And then that's at the investor level. So at the firm level, we found the short interest increase. So basically, at the firm level, we found there's more selling going on at the firm level. And also, we found price delay decrease. And also, we found the earnings timeless increase. So what does that mean is the price has become more efficient. So basically, after the conversation, after the transcript become released to the public, the price is more efficiently reflecting the information of the market. So the price efficiency increase after the expert calls. So this is like very brief overview of the findings. And I'd like to go over more of the empirical evidence and the design And I'm sure you guys have questions at the end of the presentation. I'd love to hear you guys' thoughts on these findings. So you can see that this is what kind of industry get inquired by hedge funds. You can see that a lot of these technology firms and also software, and so these are the industry who are actually get inquired by the hedge funds, and these are some of the top firms who are get targeted by these kind of hedge funds to get the expert calls on. So and then why hedge funds want to initiate this kind of expert calls? So we found some interesting evidence. First, you can see that there's some like at the firm characteristics, there's some like standard variables, asset growth, firm age, these kind of things help to explain why some firms actually will be inquired during the expert course. But there's one interesting thing you can see, that disruptive technology involvement. So basically, so one example we see that when Amazon give the AWS, it's some people like not sure about what is the AWS, how the AWS will going. So this kind of example, when some firms will have some disruptive technology, the hedge funds normally it drives hedge funds to conduct expert calls to understand this type of disruptive technology. So you can see that interesting is intangibles. It's same. So when firms has a lot of intangibles, regardless is the different intangibles, you can see that the hedge funds will ask these kind of questions during the expert calls. And then another interesting thing, you can see that when firms are covered more by news articles, there will be more expert calls. So this is counterintuitive, right? Because you think about it, if a firm are covered by news articles, that means we know a lot about the firm. Why do we still need expert calls on the firm? So that's counterintuitive. So the explanation here is the expert calls and the news, they are complementary and not substitutional. So what I mean here is when the firms have a lot of news article, that does not actually diminish the value of expert calls. Rather, you will just get the hedge funds more interested in to know what's going on with the firm. So you think about if the news article are expert calls, the information are substitutional, then we shouldn't see a positive relationship here. But we see a positive relationship here means the more news cover on the firm will trigger hedge funds to conduct more expert calls of the focal firms. So that means the hedge funds get more intrigued by the news, and then they want to do some more complementary information discovery about the focal firm. So this is about the information environment, and also we can see that the complexity of the firm also triggers hedge funds to conduct expert calls to understand the firm. So these are the determinants of the expert calls, and so this is some results I just mentioned earlier. One is expert calls. We measure the expert calls at abnormal expert calls, which means that's the change in expert calls for the firm. And then when we see that there's an abnormal expert calls happen, then the hedge funds. So the first column one means the hedge fund is trading on this kind of information. So we put absolute value. So we don't put like a directional prediction. So in general, hedge funds trade on this conversation once after they finish their conversation with the experts. And then we found the direction is always negative. So you can see that the hedge funds always sell instead of buy after the conversation. So it's going back to our literature, in the capital market. It's interesting that it's always easy to get good news, but for negative news, you have to really dig it out to get the negative news. So you can see that there's a tons of literature showing that managers will always disclose optimistic news, positive news to the market. However, for negative news, they always withheld, they always hold it back until they have to disclose. They will release those negative news. So this is consistent with the story here. So why these hedge funds want to do the expert course? Because they want to find the red flag of the firm. Because they all know about good things about everyone. They know the good things about Microsoft. They know good things about Google. But they want to know what's the hidden red flag of the firm. So that's why they want to spend time, spend money talking with experts of the focal firm, trying to get the red flag out. And then once they find, they will try to sell the firms. So this is some interesting stuff. We actually that's the beauty of big data. Like before, like ex ante, we didn't know that. Once we have the transcript of the conversation between the hedge funds and expert, we don't know this is going to happen. But the more we dig out the contents, the more we analyze this unstructured conversational data, we found some interesting stuff. We found the hedge funds, they know everything good about the firm because the good news just travels so fast. But the negative news are always withheld by the firm, by the executive teams. So how to get the negative news? So you have to go out, you have to talk to experts, you have to talk to the managers. So in that sense, the negative news is more costly to acquire compared to the positive news. So that's why the hedge funds, they are making effort here. They are kind of doing this kind of costly information acquisition, trying to talk to the experts of the Microsoft, trying to find out what is going on. And then once they confirmed what some red flags there, they're trying to sell the stocks. So these are the very interesting stuff we didn't know before we explored the data, but this is something comes out once we know more about the data and the contents of the conversation. We found that it takes sophisticated investors time and effort and the monetary cost to actually acquire negative information about the firms they're holding or interested in. And then we also find it's correlated with informed trading. So the informed trading here is also using another machine learning to measure. So basically, sometimes the difficulty of measuring informed trading is you don't know this is informed trading or it's not. So we rely on another paper who are using machine learning to measure and get accurate informed trading. And we found that expert course is actually correlated with increased informed trading, which is go back to my earlier point. So the conversation hedge funds had with these experts confirm the private information they have. So basically, before they join the expert course, they have some private information on their hand, and but after the expert course, the conversation from expert course confirm the private information they have even before joining the course. So this is some evidence we show, and then we also want to show that if hedge funds are really selling these stocks, does that mean the expert course predict future negative earnings performance and stock returns? So we want to make sure this is really red flag story. This is really hedge funds actually gets the negative news about the firm by doing the expert course. So you can see that the expert course is negatively correlated with future earnings and also negatively correlated with future stock returns. So you can see that. This is consistent with what we just discussed earlier. When the conversation of the expert course is actually predicting the future negative performance, some red flags get discovered from the conversation, and also it also predicts the future stock returns as well. So that means the hedge funds are selling for good. They are not confused. The hedge funds are not confused. They are not just irrationally react to this conference call, expert call. They're selling for good. They're selling in a rational way. So this is the evidence we kind of find from the empirical exercise. And also we want to look at the firm level, and we found not just for investor trying to sell at the firm level, it seems like an aggregate level, investors are all selling the firms. That's why we have a change in short interest. So it's not just about one or two investors. So all investors kind of follows this kind of hedge funds who conduct this kind of expert calls. And so at aggregate level, we can see that there's an increase in short interest, means most of the investors are selling the firms after the expert call. The good things is we have a price efficiency measure. You can see that the price efficiency increase with the expert calls. So that means, which makes sense here is the expert calls actually help the market to understand complicated technology information and also red flag of some production. So that means the expert calls actually help not just help hedge funds. The expert calls help hedge funds and other investors to comprehend complicated technology and also red flag in the operations. So that's why the price efficiency increases. So this is another price efficiency measure, like how timely the earnings can be incorporated into stock price. But you can just interpret as another measure of price efficiency, which also improved after the expert calls. So we also did a lot of other alternative analysis. Like we also changed how we measure the abnormal calls, we measure the contents, we measure different fixed effect. The results are pretty robust to what I just discussed. So we making kind of a couple of contributions to the literature. And one thing is, we identify a new source of a settings, which is expert calls. This setting hasn't been done in the literature at all. You guys know, like the earnings conference call is in 2008, so it's about 15 years ago. People have done earnings conference call, but millions of studies kind of following up the conference call. But this expert calls, no one has been looking at the transcript of this kind of expert call. So we are trying to provide first evidence on the transcript on this kind of expert calls, trying to understand how does this kind of new setting can help investors, and what do investors trade on it? What kind of topics they're talking about, and does this expert call help the capital market to understand difficult technology and some red flag of the firm? So this is one contribution we're trying to identify in the studies. And also we have other alternative data study. Earlier I was mentioned set the images, social media. So this kind of we also contribute to the alternative data literature. We present another new alternative data which is important to understand the negative news. So this is we also related to the alternative data literature, and also price efficiency literature. So how can we make it price efficient? How can we help investors to understand information in a more efficient way? We found, so hedge fund, conversation with experts. This will help. This will help us to understand negative news. This will help to improve decrease the price delay and improve the price efficiency. So that means sometimes hedge funds are blamed by the regulators because they sometimes during the financial crisis they're making the situation worse. But they're also doing some good things. These hedge funds, they're proactively seeking conversation with experts to understand the focal firm. By doing such a conversation, they are kind of dig out negative news, dig out the red flag of the technology or production of the firm, so help the whole market to digest the negative information of the focal firm. So they are doing something good. So you always can look at the two sides of the story. So this is So this is kind of basically what we did in the paper. And I want to spend like 1 or 2 minutes. I know I'm on the time edge, so I may just spend 1 or 2 minutes. Just want to show you guys what other things can be done using AI, using big data. So the project I presented today is just one example of alternative data, unstructured data. By understanding the hedge funds conversation with experts, you can understand what they talk about. You can understand how this conversation help investors to understand some difficult technology and red flags. So that's just one example of using the big data in the capital markets. I want to show more of like a program of research where like all scholars can actually using AI, machine learning, and the big data to understand the capital markets. So the first study is also one of my paper. So what we did is we build a machine analyst. So let's say if you want to predict the stock price of Google, so the machine we build will crawl every single information of Google, including press release, everything, the stock price, and then the machine will make a price prediction, and we horse race the machine prediction with human prediction. So in that study, we beat about more than half of Wall Street analysts. So basically, we kind of beat more than half of Wall Street analysts. But the paper we wrote here is not trying to say we want to fire the half of Wall Street analysts because we have a machine, we have AI which can replace half of Wall Street analysts. No, that's not the purpose of the study. The purpose of the study is actually to focus on why the other half of Wall Street analysts, they can survive in the age of AI. So basically, why this kind of the other half of analysts can survive in the age of AI. So we found some interesting results. We find human can understand some management team's competence better. Human can understand R&D better. So these are the skills human have, but machine do not have. So this is some implication for training our students. We should train our students with skills, something unique to human and cannot be replaced by machine. So train them how to understand the firm's management team, how to train them to understand the R&D, because these are the skills machine do not have, but human have. So we're trying to provide implication for, how to survive in the age of AI. And then some other studies, you can see that in the second study, we show that if I'm a manager, if all of my financial statements are read by machine, not by human, how managers should make machine readers happy instead of make human readers happy? So these are also another related study. So let's say if I'm presenting here, if I'm not presenting to human, I'm presenting to machine. I'm sure you are not a machine. I mean, if all of my audience is machine, how can I make my machine more understand my message? The way I talk to machine should be different than the way I talk to humans. So say in the similar logic, we are trying to understand how the managers, they are trying to make the algorithm happy when they release the news, rather in construct to human audience. So these are like other studies you guys can check out on my website. So the basic message I want to send here is there's a lot of things can be done in area of big data, AI, and machine learning. Today I'm glad I just share one small piece of the research programming in this area, but I'm think there's more opening area and the invitation for opportunities for you guys to explore more exciting ideas and data. And I will give the floor to Xuefeng, and also love to hear questions.